Hi, this is Mike Maloney, and a lot of viewers have been asking for an update on Hashgraph. And I just finished the most amazing interview with Mance Harmon of Hedera Hashgraph. But he does get a little bit technical on some aspects. So if you don't know much about cryptocurrencies and digital tokens, you might want to go watch my episode 8 of Hidden Secrets of Money, because that really dissects it and you're going to really understand what he's talking about. Then come back and watch this interview. And the reason you want to watch this is because whether you're interested in cryptocurrencies or not, it's based on distributed ledger technology, and distributed ledger technology is already affecting our lives in major ways, and it's going to affect your life more and more and more as we go forward. So if you want to understand what's happening to you in this world and have a sort of you can say like, oh, that's why this is happening, you really do need to watch this episode. So now, without further ado, here's the interview. Hi, this is Mike Maloney, and I've got Mance Harmon on the line here with me for an update. There's been a lot of viewer questions, and we did episode 8 almost 3 years ago, or more than 3 years ago. So, Mance, how are you doing?
Oh, I'm great. Thank you. It's great to see you and be back with you again here today.
I've got a lot of viewer questions, like I said, and we need an update since we made episode 8. Can you give us the 40,000-foot view?
Okay. Well, Hashgraph as a piece of technology is an alternative to blockchain. So they both are consensus algorithms, distributed consensus algorithms. Blockchain, of course, became famous because of Bitcoin and enabling Bitcoin more than a decade ago. Hashgraph solves a bunch of the fundamental problems associated with blockchain. Specifically, it improves performance by orders of magnitude if measured in throughput and latency, how long it takes for this community to come to consensus on the order of transactions. So performance improvements as well as security improvements. Hashgraph achieves the theoretical limits for the field of distributed consensus in terms of security. And so it improves upon the first and second generation technologies significantly, but that's what Hashgraph is. It's a consensus algorithm. Hedera is an organization that's using Hashgraph to create a global public network that enables developers to build distributed applications. And of course, it has the advantages of Hashgraph, but it's also unique in the industry in its governance model. What we have is a council that will ultimately be 39 global blue chip organizations, as well as NGOs and universities that provide the oversight of the governance of the platform. So there's a technical steering committee, for example, that oversees the product roadmap. There's a legal and regulatory committee and marketing and so on and so forth. It's distributed governance by organizations that have an interest in building enterprise-grade distributed applications.
Okay, like I said, it's been 3 years since we made episode 8, but just before we made episode 8, we came to New York to an event that you were putting on. And so I guess this was shortly after you created the company for Hashgraph. And so we were one of the very early people to learn about this. And, I'd been following, I attended a conference called Bitcoin on the Beltway back in 2014 and started investing in cryptos back then, announced that to all of my insiders that I was putting a percentage of my portfolio into cryptos. And then all of the footage that we had taken from this journey sort of got canned because we went into this crypto winter. So during the making of episode 8, though, it was a revelation for us. We realized that this, even though it didn't exist yet, that it was going to be in a very, very powerful technology. Now, before we get going on this, I want to let everybody know that I've never been paid by Hedera Hashgraph. We made episode 8 we had all of this footage of my journey through Bitcoin and cryptocurrencies in the can, but there was really no news or interest in this. And when we saw your event in New York, we just decided, wow, we've got to get this out. We got to get it out quick. And it just happened to coincide with the release was right at like the Bitcoin, one of its peaks. And then it went into another this winter. And that winter is when I invested in an early funding round of Hashgraph. But can you tell us about why this technology is so much more powerful than regular blockchain technology, in your opinion?
Yeah, well, from a tech perspective, it's pretty black and white. There's no subjectivity. It's just math. And blockchain is inherently serial in its operation. What I mean by that, just conceptually, there are people that want to submit transactions to a blockchain network. All of those transactions go to a set of what we call miners. All the miners in the network that are running nodes in the network collect all the transactions, put them into a block, and they compete with one another for the privilege of putting the next block on top of the chain. And they do so by trying to solve a hard math problem. And once they've solved it, they take their block, they include with that block a proof that they solved the math problem. This is why it's called proof of work. It's proof that they actually did the work to solve the math problem. And they send that block with the proof to all the other miners. And then, upon validation that the work had actually been done, they take the block and they put it on top of their local copy of the chain of blocks, the blockchain. This is how blockchain works. So it's very slow. And the reason it's slow is because the miners have to do this proof of work first. And it may be that miners solve the problem at about the same time, and the community has to be given time to resolve which miner actually solved it first. So it's inherently a slow process, but it does work. It results in a stream of transactions that have been put into consensus order. That's important if you're keeping a ledger of accounts and recording the transactions and the order in which those transactions occurred. Hashgraph, on the other hand, is inherently parallel. There are no miners, there are node operators, and all the node operators just submit transactions to the network, to all the other node operators as they flow in. Now, this is going to sound like black magic, but conceptually, this is how it works. As the transactions flow in, each of the node operators keeps an account of that. And as they pile up on top of each other, the nodes in the network, through the magic of math, can come to an agreement on the order of the transactions. And it's guaranteed. They have 100% cryptographically secure certainty on that order of transactions. Because it's done in parallel, and there's no need to slow things down to allow the community to come to agreement, Hashgraph can just process orders of magnitude more transactions per second and come to agreement on the order of those transactions within seconds. It's just a huge leap beyond what was first introduced there by blockchain. And conceptually, that's how the technology works.
Okay, so just for anybody that isn't that familiar with blockchain, so you've got all of these miners, millions of computers, making trillions of guesses per second on a really big number, and the computer that solves it gets a reward for solving it, mining the coins, and that block gets to be the block that is updated, and all the other millions of computers around the world agree on that and update their ledgers to match. But because of the potential of disagreement and two people winning at the same time and something called soft forking, they have to slow it down to where it's about one block every 10 minutes, correct?
Exactly. That's precisely right.
Okay. And those blocks can only hold a certain number of transactions. So you've got this big pool of transactions. They're selecting some of them to fill up this block, but the blocks are limited in size, at least on Bitcoin. There are others that aren't. And then if computers start solving this guess at this really big number too quickly, the system increases the difficulty by adding another digit to the number that they've got to guess. And so it always tries to maintain this 10-minute block time that's updated, where Hashgraph does this pretty much instantly by comparison, and you don't have the limitation of how many transactions can fit into a block.
That's right. There are no blocks in that traditional sense.
Each transaction is its own event, right?
Correct.
Okay.
It can be, and they all just flow in. The entire community of node operators receives all of them, and as they fill up the hash graph, which is a data structure, sort of like blockchain is a chain of blocks. There's a graph of transactions that fills up, and as it fills up, the math of the algorithm results in all the miners coming to an agreement very quickly on the order of those transactions within the graph. So it's very different in its function with some fantastic properties relative to blockchain.
Okay. Now, I sort of have to repeat this one more time for all of our viewers. I've never been paid by Hedera Hashgraph. This is just an update because everybody's asking what's happening with Hashgraph. I did get in on an early funding round, and so that's my only connection with Hashgraph, is that they allowed me in on an early funding round. So can you tell us what has happened with Hashgraph since we filmed 3 years ago, since that meeting that you had in New York where you announced this?
Yeah. Right. So it seems almost like a lifetime ago.
Yeah, I mean, this was giant news at the time. And that's the reason that we go, oh my God, we've got to finish this Bitcoin episode, because it was a Bitcoin episode until that day. Then it became from Bitcoin to Hashgraph.
Yeah,
exactly. We had, like I said, we had been filming for years on it and putting stuff in the can and couldn't release it because there was just no interest in Bitcoin during that period of time.
Well, so in 2017, Lehman and I came to the conclusion that we had done enough in terms of maturing the technology and interacting with the market and understanding the market, that we could build a public network on top of Hashgraph using the Hashgraph technology. So we began writing it all down. This is the 50,000 foot view of sort of the company life cycle so far, in my opinion. And we wrote it all down. We created a white paper. We hired the initial team, just a small group of us, in the fall of 2017. And then in 2018, we introduced Hedera Hashgraph, the organization, to the world. That was in March. And I think you may have even been there at that event in New York City. And we introduced the world to Hedera Hashgraph. We raised a lot of money, and we launched the network in the fall of 2018. It was closed. Only certain developers and partners could get access to the network, so it wasn't open to the public yet, but it was functional. In 2019, we operationalized the council, the governance model associated with the technology and the network. In February of 2019, we added our first 5 members of the council in Seoul, Korea, had an event in Seoul, Korea, and that's where we sort of inaugurated the council. And then through the remainder of that year, we continued adding members to the governing body, and we opened the network to the public in the fall of 2019. And it launched with 3 services: cryptocurrency as a service, distributed file storage, and support for smart contracts. Last year, in 2020, we observed how the market was using the platform, how it was interacting with it, the use cases that the market brought to the platform. And we decided to add some additional services that really helped to achieve product market fit, to use that term. First was the Hedera consensus service, which really just exposes Hashgraph as a service to developers, and we could talk more about that perhaps later. And then later in the year, late last year, we decided that it was time to build a tokenization service in addition to just the cryptocurrency service. Basically, take the cryptocurrency service, augment it in various ways to create a general purpose tokenization service. And we're just preparing to launch that, have the marketing launch here in a few weeks. So 2020 was all about understanding how the market interacted with the platform and getting product market fit, making sure that we had the right products built for the market demand for our technology and its value proposition. Now this year, 2021, is what I consider the beginning of the growth stage, sort of scaling the platform for various use cases that we've identified and just repeating that process. And so yeah, this year's a big year for us. We made a lot of progress since we talked a few years ago, and now we're just entering growth phase.
So this is the year that Hedera Hashgraph, where the rubber really meets the road, right?
It is. We already have dozens and dozens of customers. What we want to now do is turn that in. I shouldn't call them customers. They are developers or companies that have elected to use the platform. They do so on their own, right? We don't have interaction with most of them. Some of them we do, but they've decided to use the platform. Now we want to turn that into hundreds and hundreds, maybe thousands of users of the network.
Okay. Some people are saying that Hedera Hashgraph is not decentralized. Can you sort of clarify this for us?
Yeah, the first reaction that people have when they look at our governance model is that it's a bunch of large corporations that are making the decisions for the platform. And when we talk about large corporations, I view this as a strength, certainly not a weakness. It's by design that we've chosen this governance model. There are organizations like Google and IBM and LG and Boeing and Tata Communications and FIS WorldPay, those types of global organizations. And they govern, meaning that they make decisions regarding things like product roadmap and use of treasury. So they literally govern the organization in that way. But when people think about, say, Bitcoin or other platforms like Ethereum, what many of them fail to realize is that there may be hundreds of developers that are writing code, but there's just a handful of core developers that make all the decisions regarding the product roadmap, for example. You know, a dozen core developers are the ones that sort of hold the keys to the baseline code base, the real changes to the code base. So in that sense, we're more decentralized than the largest platforms in terms of its governance. Also, importantly, the governing council that we have created is by design meant to be decentralized in that it's not the council members are not coming from a single sector. They're chosen to be cross industries, cross sectors. They're also geo-distributed. So we have council members from Asia and Europe and the US and the Middle East and South America. By design, these council members come from around the world. So we've been intentional in creating a governing body that is meant to be representative of all use cases, all constituencies on a global basis, not governed by a handful of developers. So that's the difference, and that's my reaction and response. One other thing, I know that a lot of people will look at the number of nodes in the network and say, well, you don't have thousands of nodes running. That's a true statement. That's also by design early on. And it has everything to do with protecting the security of the network. We have the council members today running the nodes in the network that will scale to non-council members, and then ultimately nodes that we know nothing about, or at least we haven't KYC'd or given permission to nodes to participate in the network. Ultimately, permissionless nodes will be able to participate in the network like all the other platforms as well. But there is a challenge, and that challenge is when you start a new cryptocurrency, like we did with HBAR, and you're using a consensus algorithm, then the math works out such that if a bad actor can buy up or hold a significant portion of that cryptocurrency, they can interfere with consensus. And so the challenge is to increase the distribution of that cryptocurrency broadly enough across a lot of different participants in the network, and have the price of the cryptocurrency high enough that a bad actor practically can't buy up a third or more of the tokens in supply. And so the way you do that is you start with a collection of highly trusted entities that are going to manage treasury. And then as you achieve that decentralization in the token and increase in value, you then add additional nodes and you get decentralization and consensus. That's the path that we're on. And we're again being very intentional about the opening up of the network and adding other nodes that are not council member nodes, but it has everything to do with protecting the security of the network.
Okay. You touched on your consensus service earlier. And, my producer, Dan, says that this is probably the biggest thing in the distributed ledger space ever. It's plug and play consensus for these developers that don't have to write their own code to create their own blockchain token anymore. They can just plug into this and they're ready to go. So basically, you're the layer underneath that. They've got their website, their tokenized whatever it is, and below that, the thing that is doing all the accounting, keeping track of everything, is Hedera Hashgraph. Can you tell us about your consensus service?
Sure. When we look at the range of public ledgers today, as opposed to the private ones, when we talk about private networks, just to be clear, there are frameworks out there that are designed for organizations to get together, create their own consortium, and run a private network that doesn't allow just the average person to participate. That's not what we're talking about. We're talking about the public networks like Bitcoin or Ethereum, EOS, Algorand, the others, where anybody can use the network if they so choose. For the public networks, they all do two functions. They perform two functions. They accept transactions flowing into the network. They put those transactions into a consensus order. And then once they have the transactions in consensus order, they feed that stream of transactions into a business logic layer to be operated on, the smart contract layer that people normally refer to, the smart contracts. The problem with this model is that smart contract layer is developed by developers around the world. And any developer can create their own smart contract and put it onto the network, and then they compete for CPU cycles on that network to operate or run their smart contract, to process the business logic that's in their smart contract. Because we have many thousands of developers building smart contracts and all trying to get time on the same nodes that do consensus, the cost of operating a smart contract is exorbitant. It doesn't scale well. And in addition, it's not private. If you have, say, you want to add variable A to variable B, you have to know the value of A and B. And it's on a public network. The entire world can see the data that is being operated on in that smart contract. So for enterprises and organizations that care about privacy, this is a non-starter. what we realized is that we could split apart those two concerns. We could create a service that simply does consensus ordering, but companies, organizations can take the smart contract layer, quote, quote, the business logic layer, and put it into their own private network. And they can get the benefits of consensus, distributed consensus in a public network for transaction ordering, with the benefits of a private network for scale, low cost, and privacy. This essentially solves the enterprise problem of scale, cost, and privacy while using a public network for consensus. That's the change in the model. Our enterprise customers, a lot of our non-enterprise customers are looking at this exclusively as the model that helps them scale their enterprise grade solutions.
Wow. I had no idea. This is a new one for me. I didn't realize that there was so much difference. I didn't realize that the smart contracts that are operating on blockchains, where all the data, so you're putting in financial data when you're making an agreement on something that's basically being put into escrow or something like that.
Right.
Everybody can see how much you're paying, how much you're selling for. Wow. Okay. So the tokenization service, you've launched something called Hala, and another one called Toco. Tell us about Toco, what this is, and how this service works. That can be, some organization that needs this can basically sign up for this, right?
Yeah.
Okay.
Well, I mean, let's talk about tokens generally for a moment to sort of set the context. When we think back to 2017, the cryptocurrency world was just on fire because people had discovered they could create a token and sell it to sort of crowdsource funding for their organization. So the technology enabled a new type of crowdsourcing of capital for standing up a company. Now, there were all kinds of regulatory problems with that, and the regulators got involved, and the ICO craze came crashing down in 2017. However, this idea that tokens could exist, digital tokens could exist and perform functions that were previously difficult, if not impossible, to perform, caught hold. And today, there are a range of different kinds of tokens, token types, or tokens that can be used for various things, including supply chain tracking and security tokens that make it possible to take securities that are considered securities and tokenize those securities and have them traded on special exchanges that enforce the regulatory constraints or requirements if you're trading securities, as one example. And so the world of tokenization has changed a lot since 2017. What Toco has done, and Toco, by the way, is a platform that was created by one of our council members, DLA Piper. DLA Piper is a global law firm, one of the largest law firms in the world. Scott Teal is the man in charge of this new product that DLA Piper is coming to market with called Toco. Toco makes it possible for those that want to create a token, issue a token for something in the security space. It could be real estate, it could be artwork, collectibles, tokens generally, but I think they were originally focused on real estate, commercial real estate. Makes it possible to create a token and issue it, take it to market in sort of the way you might take a security to market. It uses the consensus service that I just talked about, the Hedera consensus service. What they did was they took Hyperledger, which is one of these frameworks for private DLT networks. They created their business logic in a private network using Hyperledger, but then Hyperledger turns around and uses our consensus service, the Hedera consensus service, for putting all the transactions into consensus order associated with those security tokens. So it's the combination of the two, public trust in a consensus service using Hashgraph with the benefits of a private network in terms of scalability and security and privacy. And they took that to market in November. They're doing quite well. I think the first thing that they tokenized, just to demonstrate that it's real and possible, was a piece of artwork. They took a painting and they split it up into some number of pieces. They created non-fungible tokens. Each token was unique in that it represented a piece of that painting, and they issued it as a security token, and it's now trading. So that's what Toco's doing, and that's using HCS. What we realized is if you want to create tokens that are maximally configurable, then use HCS. But there are a lot of use cases where you want to spin a token up in 5 minutes and just use it, maybe because it's part of a game. You have game characters or objects in a game that are non-fungible tokens or other, and you want a quick way of doing that. Then what you can do on our Hedera token service is exactly that. The Hedera token service makes it possible not to use a private network, but to just within a few minutes spin up a brand new token, have it issued and available for trading on the network, and it covers 80% of what token managers or issuers need to manage their tokens. And so that's the new service. And what we believe is that we're moving into a world where everything is going to be tokenized. And this is going to be a many trillion dollar market, because the markets that currently exist, the assets that exist in those markets of whatever form we're talking about, each one of those assets will end up being tokenized because of the efficiencies that come from tokenization. So the Hedera token service enables that for the average token, and the Hedera consensus service enables it for tokens that have special needs and need maximal customization.
Wow. I used to go to the Pebble Beach Concours d'Elegance when I lived in California. I'm a car guy. I just love cars. And all of the collector cars there. I mean, this is the most prestigious car show in the world. And there are cars now that go for 5 million, 10 million, 20, 30, 40, 50 million bucks. And one of the things that you want when somebody buys a car like that is you need to know the car's history, every hand that it has passed through. If it was ever in accidents, the repairs, things like that. The car's history is extremely important. Once the car is tokenized, the history from that point on automatically comes with the purchase of the car. Am I correct?
Exactly.
So, I mean, everybody that has owned a piece of that, and you could sell shares in a car now instead of one person bidding on the car and having it. So you could have 100 people that have ownership in that vehicle, because these are becoming investments now as much as, a cherished possession.
That's it.
Person. Yeah.
What you raise is a really interesting and important point, or it leads me to an important point. Provenance as a use case, tracking who has owned a widget in the most general sense, from the time the widget was created until its end of life. That as a use case has been one of the primary use cases that the distributed ledger industry, blockchain industry, is focused on for years and years and years. What's new is that the realization that all of that information that had been stored in the ledger, just recording the provenance of a widget, if instead you issued a token with the widget. When it gets created, you now have the same information. You still have the provenance, but the token by its design, by its nature, is designed for economic activity. And by transferring the token from one owner to another, you've transferred ownership of the widget. So you have the benefits of a ledger in terms of recording who has owned what and when, and what those transactions between parties look like. But the design of a token for economic activity and managing the monetary value transfer that's now associated with that widget, all in one package, that being the token.
Wow. One thing I wanted to add to this conversation, this isn't like a viewer question. This is a question that I just had. When you were introducing this at that meeting in New York back in 2017 or whenever that was, one of the things you talked about was a trust layer for the internet.
Yeah.
And about securing things, even things such as email and so on. Can you expand on the trust layer and how this is going to make the internet, I mean, with transactions and so on, it definitely increases the security. You're less likely to get scammed in the future. But how does it secure things like email and so on?
Yeah, well, when we think about the way the internet works today, it's siloed. It was meant to be decentralized, and in some sense, maybe it is, but the applications that are running on top of the internet are siloed, and they're owned by massive companies. The biggest tech companies you can imagine control, most of the traffic that happens on the internet, and they have a captive customer base in those siloed applications. If we're talking, let's just use a token as an example. Let's say there's a token, it has some value. There's a ledger that records who owns a certain amount of value for these tokens. There's some kind of identifier for a user, and then there's another field that says they have 1,000 Bitcoin or whatever, right? Whatever this token is, 1,000 HBAR. The problem is that if that's a single organization, you have to trust that organization with the ledger. You have to trust not only that they're not going to tamper with the ledger, but that they are protecting the ledger such that a bad actor can't break in and tamper with the ledger in some way. Change the values in the ledger, delete the ledger, modify its history, etc. When we talk about the trust layer of the internet, what we're saying is that we're creating a layer that removes the need to trust a single party with that ledger. So if you have a collection of parties like the council or many thousands of nodes that are voting on the order of the transactions that result in the update of that ledger, and that ledger is distributed, meaning that each one of those nodes has a copy of that ledger, there is no single party that can go in and modify the ledger for whatever purposes, good or bad. They can't do it. It takes a bad actor to control at least a third or more of the voting weight on the order of those transactions, which is practically impossible at scale. So we've eliminated a major source of vulnerability in knowing that our data isn't going to be modified to our disadvantage in some way. From there, you can build any kind of application you want. It could be an email client, an email exchange, or it could be, one of our customers or partners is taking video in Syria and pictures of things that are happening on the ground, and they're hashing that information. They're creating a digest, and then they're recording it on our ledger. And we have all these nodes that are giving it a consensus timestamp, which makes it possible to prove in the future when somebody presents video that video has not been tampered with. It's tamper-proof images or video or text that's important to people on the ground in a war-torn country like Syria. It's that level of trust that's being created for the first time. There's not a tech giant that can go in and say that that's that's correct or not correct. We have the proof that it's not been tampered with for the first time. We don't have to trust anybody with that.
That in a world where they can just take an image of somebody and then make that person say anything on video that they want. All they have to do is type the words in, put in the motions, and it looks real. It's completely fake. This is going to be a very, very important thing. Anyway, the very last question here is, what do you see as the future for blockchain and Hashgraph? Where is the industry headed? And then just give us any of your other opinions or comments you want, and we'll close this interview.
Well, so a couple of things immediately come to mind. The world of blockchain sort of bifurcated in 2015. It was clear to the industry that there was real value here, but the existing public networks just couldn't scale and they were going to be too costly. And so these private network platforms like Hyperledger and Corda and others, EEA, popped up to try and solve that problem by creating private networks. What I see now is that after years, it's the case that the industry at large, companies specifically, have discovered creating and governing and managing a consortium in a private context is really hard. It's not nearly as simple as people might have thought it would be. They can spend years trying to create these consortia at the expense of getting the business logic that they care about completed and deployed to solve the real business problem. So we're seeing a move away from private networks to public networks. The use and adoption of public networks by enterprise is happening, and we see it throughout our business, in our partners, our system integrators. We see it everywhere. So I think that public DLT is on the rise, number one. Secondly, I think that while 5 years ago, even 3 years ago, we were looking for killer applications. The industry was looking for the use cases that would benefit the most from this new type of technology. And what we're seeing today is not grand vision. We're seeing use cases and working out the mechanics, the workflows that actually will benefit. And I see this in the enterprise. And it's a combination of tokenization and stable coins, solving the price volatility for value transfer. We haven't talked about stable coins, but the idea is that you can create a token that's pegged to some underlying asset like the dollar or other, so that it doesn't have the volatility of a lot of cryptocurrencies. But it is a token, so it has all the benefits of a token. Tokenization and provenance and DeFi, decentralized finance, it really quickly, all that means is that finance operations can be componentized and embedded in workflows. And we see this happening in enterprises. So you have a widget that gets created in a supply chain. It gets a token from the day it's born. It carries its provenance. It can be traded. It can be used as collateral for getting a loan against it, for example. It can be associated with purchasing of insurance, shipping insurance, perhaps. It can be associated with an accounts receivable, and this DeFi component can be used for factoring that accounts receivable associated with this widget. All of that is being enabled by tokenization and DeFi, and it's going to revolutionize the way that companies operate and all parts of finance associated in the supply chain. And that's just supply chain, right? There are a lot of other use cases that are going to be disrupted and benefit from this world of tokenization that we're moving to.
Wow. Uh, it has more business applications than I had ever thought. I'm just absolutely amazed at what you just said. Most people think of any cryptocurrency or a token as just something that can be traded peer to peer, and that's it.
Right.
That's basically what how Bitcoin was first imagined. It's just a payment system, peer to peer, skips all of the banking system and any other what I call frictional losses that you have when you've got other people, other organizations involved managing it. So it lowers cost, increases security. But this does so many more things. I think the future then of blockchain and Hashgraph is bright for both of them, but I think Hashgraph has a little bit of an advantage. So I want to thank you so much for this interview. And do you have any last thoughts? Anything you want to add?
No, well, thank you. It's a pleasure being here. I certainly appreciate your interest in this, and those that follow you. We're very excited. It's been a fantastic journey so far. Like we said from the very beginning, we started this wanting to create a 100-year company, a company that's going to be around for 100 years, and feel more strongly about that today than ever before. We're on a great path.
Okay, well, thanks a lot, Mance, and say hello to Lehman when you get a chance. I want to thank all of our viewers for watching this. I'm Mike Maloney. This was an interview with Mance Harmon of Hedera Hashgraph. So thanks a lot, Mance. We'll see you next time.
Thank you.